Thank you for joining today's webcast entitled Preparing for the Pandemic's Impact on Your Pension Plan, Year 2. My name is Hank Kim, and I'm NCPERS Executive Director. Today's program is part of our Center for Online Learning, which provides remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. Despite investment rebounding in the latter part of 2020, the ultimate impact of the global pandemic on public pension plans remains uncertain. Investment markets continue to be extremely volatile, while economic activity has been sharply reduced as many of us stay at home. What should public pensions expect in this environment, and how can they best position themselves both during the pandemic and as the economy recovers? This webcast will explore the varying impacts on public pensions, including some of the non-asset events, such as surges in retirement applications, layoffs and furloughs, mortality experience, and early retirement windows. Today's event is sponsored by Cheiron. Cheiron is a full-service actuarial consulting firm with a reputation for integrity, creativity, and technological prowess. The firm is known for its pioneering work with public pensions, particularly in measuring and managing risks. Cheiron advises many of the nation's largest public and Taft-Hartley pension plans and health and welfare plans. The firm is often asked to advise financially troubled plans to help them navigate through difficult times. Today, we have back with us Bill Hallmark. Bill is a nationally respected retirement consultant with more than 3 decades of experience advising pension plans. He's a frequent speaker at industry conferences, presenting on topics such as principles of funding, risk metrics, disclosures, and financial reporting. Also from Cheiron is Karen Zangara. Karen has more than 2 decades of experience as an actuarial consultant working with public, Taft-Hartley, and single employer plans. Her experience includes helping plan sponsors understand potential risks their plans face and providing annual actuarial valuation results. As always, we encourage audience participation. Please submit your questions by using the chat function of this platform. Bill, Karen, I'll turn over the webcast to you now.
Thank you. In last year's webinar on preparing for the pandemic, we discussed some potential issues for public pension plans. We want to start this year by reviewing our expectations compared to what actually transpired. Then we'll consider what plans can expect looking forward from today and how to position them to protect against risks and take advantage of opportunities. A year ago, COVID cases and deaths seemed to be skyrocketing. People were in lockdown, travel was shut down, restaurants, concerts, movie theaters, and most stores were closed. The only items people were buying were food and toilet paper. It became clear that internet and streaming services were essential services. The stock market plummeted and unemployment exploded. It was scary, and we expected a disaster. In many ways, especially the human toll, those fears were realized, but the economy and the investment markets didn't exactly behave as we expected. Reality, as always, is a bit more complicated. While there were earlier indications a year ago in March is when most of us first realized how significant COVID-19 might be. Governments issued stay-at-home orders, the NBA suspended its season, and 6.6 million people applied for unemployment in a single week. In April, masks were first recommended, and we appeared to be flattening the curve through the rest of the spring. As summer approached, the pandemic spread across the country. It again appeared to abate, even though new cases never got below the peak from March. Then, around mid-October, a powerful third wave emerged, and new COVID cases and deaths reached unimaginable peaks. By mid-December, there's a ray of hope as Pfizer and Moderna vaccines are approved. But the rollout of the vaccines takes time. COVID cases dropped precipitously between January and March as at-risk Americans are vaccinated at an accelerating pace. However, new variants have emerged and new cases plateau at a level above the spring 2020 peak and almost as high as the summer peak. According to Johns Hopkins, the US has had over 32 million confirmed cases of COVID and over 570,000 deaths. But there is renewed hope as vaccinations reach a substantial share of the population.
When COVID first hit, there was a sudden economic stop and unemployment rates skyrocketed. But how does this compare to the Great Recession and the prior economic shutdown in 2008? This graph shows US unemployment rates from January 2007 through March 2021. When the financial crisis hit in 2008, over a year, unemployment rates spiked up to almost 10%. And then over the next 10 years, during the Great Recession, there was a gradual decline in unemployment rates until by January 2020, these rates had gone down to 3.5%. Then COVID hit, and suddenly in a matter of months, unemployment skyrocketed again, this time to almost 15%. But when compared to the Great Recession, which took years of recovery for unemployment rates to come down, this time, by March 2021, unemployment rates had spiked down, not to the pre-COVID rates yet, but down to 6% now. This shows a very different recovery process that occurred under COVID versus the Great Recession. Now looking at the economic impact by location, we're going to be showing to you the state unemployment rates from 2020, during 2020 onward. The state colors will show the unemployment rates, and you can see in that key below how the green states will have unemployment rates less than 4%, yellow states will have unemployment rates between 4 and 6%, and so on to red states that will have unemployment rates greater than 12%. We're not showing all of the months in 2020, just some key months that we thought you might find interesting. So beginning in January 2020, you can see that almost all states are green, and then COVID hits in March and suddenly unemployment rates increase, especially in April when over 20 states have unemployment rates 12% or higher. Things improve in July, and by October, some central states are turning green on their unemployment rates, and unemployment rates improve in January 2021, and by March 2021, there's 12 states that have unemployment rates less than 4%. We don't have the data yet for the April unemployment rates, but it seems like based upon reopening that these rates will continue to fall. On the next slide, we're showing how the economic impact varied by occupation. This graph shows the increase in unemployment rates over the past year, and we're showing it for 13 different industries. If you look at the bottom of the graph, you can see for mining, this had almost a 9% increase in unemployment rates in the past year because of decline in demand for gas and oil, because people weren't traveling, and because manufacturing was down. Not surprising, leisure and hospitality also had an increase in unemployment of about 5%. And the information industry, which includes the movie picture industry, also had an increase in unemployment. The only bright light here is that for agriculture, they had a decline in unemployment rates by 1%. This may explain some of those central states on the prior slide turning green during the fall of 2020.
With the sudden economic stop a year ago, one of our big concerns was the projected drop in tax revenues and how that might affect public pension plans in terms of employment levels, salary levels, and perhaps most importantly, the ability of sponsors to make contributions. The projections varied by location, reflecting the underlying industries and sources of tax revenue, but all were pretty bleak. Fortunately, it didn't turn out that way. For example, the Center for Budget and Policy Priorities had forecast a $185 billion shortfall for 2020. But in hindsight, they estimated the actual shortfalls to only be about $22 billion. Preliminary analyses seem to indicate that the nature of the economic stop, being concentrated in certain industries while other industries fared pretty well, combined with the federal stimulus, where there were significant unemployment benefits and paycheck protection programs, worked to protect state and local tax revenues more than expected. Looking forward, there are significant uncertainties driven largely by the pandemic. But there's also additional federal stimulus in the short term, including $350 billion in direct aid to state and local governments, and potentially even more stimulus over a longer period. We've all learned that investment markets are not the economy. In March of 2020, the stock market plunged, generating numerous headlines about the consequences for public pension plans. Markets quickly recovered, however, so by June 30th, investment losses were moderate compared to assumptions. Then markets kept going up. For most of my clients, the fiscal year return to date this year is around 20%. I hope that doesn't jinx it for the last couple of months. One of the questions we as actuaries are frequently asked is about the impact of mortality during the pandemic. The Society of Actuaries recently published a study of excess mortality in the US population during the pandemic, and the results are interesting. The excess deaths due to COVID, as shown by these red bars, generally rise with age and are greater than 15% over all ages. While the excess deaths weren't as high for younger working ages, like 15 to 54, the interesting finding is that there were excess non-COVID deaths, shown by these gray bars, that were higher for these age groups, resulting in a total excess death rate similar across all ages and averaging around 20%. The other interesting finding here is noting the negative excess deaths for children. We can speculate on the reasons for the non-COVID excess deaths, from despair to missed medical screenings or procedures, or the frequency of accidents during the pandemic. But the study didn't quantify any explanation, so some further analysis would be needed and probably additional CDC data before we can assess what caused the excess deaths. There are two important notes on this study as it relates to public pension plans. First, the study encompasses the entire US population. We know that COVID hit certain communities harder than others, so the impact on the US population as a whole may not be indicative of the impact on public pension plan members in general, and especially of public pension plan members in a specific region. I know some plans that are tracking closer to a 3 to 5% excess mortality. However, there are other plans that appear to have experienced a substantial increase in mortality. The second piece to note is that these increases in mortality will likely have a relatively small impact on public pension plan liabilities, unless they are sustained for many years. Even with a significant increase, it would be difficult for a one-year mortality impact to change the liability by even 1%. Sticking with the subject of mortality, you may have seen the report that US life expectancy dropped by 1 year. These are provisional calculations by the CDC reflecting mortality rates in the first half of 2020. And this is the largest reduction since World War II. When they incorporate the experience from the second half of 2020, there could be further declines in the life expectancy. It's also worth noting that the life expectancy change was not similar across all populations. The CDC release shows it broken down by race and sex, and there are some significant differences. For our purposes, however, the most important thing to note here is that this calculation assumes someone's entire life is subject to the mortality rates from 2020. If mortality rates revert to their previous levels, the life expectancy calculation will also immediately return to its previous level, potentially resulting in some of the largest declines in life expectancy.
So what has been the financial impact of COVID on public pension plans? Well, first of all, some of our worst fears were not realized. A year ago at this time, some of my pension plans were saying, what will happen if we can't pay our contributions? Can you do projections and come up with alternative schedules to make up these missed contributions? But in the end, these initial concerns were not realized. And the concern about budget cuts potentially affecting contribution did not happen. Also for investments, when the markets collapsed in 2020, there was a lot of concern about what that was going to mean for pension plans going forward. But as Bill mentioned, the markets recovered quickly. And for my plans that are calendar year, the returns were much higher than the expected return on assets. And for June 30 pension plans, well, so far, fiscal year 2021 has been very good. Knock on wood, it stays that way, and they'll continue to be strong. What has been the demographic impact of COVID on public pension plans? As Bill mentioned, as actuaries, we frequently get asked about this, especially for the mortality impact. Will there be increased deaths? Will this cause a gain in the liabilities? Will this change mortality expectations in the future? Well, as Bill mentioned, the impact for public or for pension plans is not expected to be as large as for the general US population. And even if there is an increase in deaths this first year, we're not expecting a large change or gain in liabilities above maybe 0.2 to 0.5%. For retirement rates, we're seeing higher levels of retirements for some pension plans, particularly teachers. And for plans that have drops, we're seeing there's participants not going into the drops as past behavior indicated. In other words, participants that were in the drop went to full retirement sooner than expected, and participants that were thinking of retirement didn't go into the drop, they went to full retirement instead. For termination rates, we may see higher levels than expected, particularly due to childcare needs and for women taking terminations. Also, terminations might be higher than expected due to safety workplace concerns. For disability, there may see increases here as well, as particularly for frontline workers or just for long-term COVID impact, and as that slowly unfolds and we have a better understanding around it. And early retirement programs and furloughs, well, generally, there appears to be more discussion than action. We saw some furloughs, but they were shorter than expected. While some of my pension plans considered early retirement programs, they were not to the extent originally considered. We expect the 2021 funded ratios to improve on a market value of asset basis. This graph is going to show the median funded ratio based on market value of assets. And these median funded ratios are based upon the public plan database. You can see here from 2010 up to 2020, funded ratios on a market value of asset basis increased overall, went from 66% funded up to about 71.6% funded. For each year, there's about 200 pension plans in this database. And for the majority of these pension plans, they're June 30th years. You might not be able to see this very well, but for 2014, that median funded ratio on a market value of asset basis is 78.9%. So over the past 10 years, the funded ratio on a market value of asset basis has improved. And this is in spite of the fact that the majority of public sector pension plans have reduced their discount rate to reflect lower expected return on assets in the future. So what's that mean in terms of the 2021 funded ratio? Will this go up as well? We think it's likely, although this might be tempered a bit if it's decided to change discount rates and bring them down a bit more to reflect future lower expected returns. Also, just to be clear here, this is a market value of assets funded ratio, not the actuarial value of assets that smooths market gains and losses over a certain time period.
So that brings us up to today. But now, what should we expect going forward from here? First, we want to note that there are many reasons for optimism. Vaccinations are happening quickly, and while COVID is still spreading, we can see the beginnings of a more normal future. Schools and businesses are reopening, people are planning vacations, and there is significant federal stimulus to jumpstart the economy. But as actuaries, we are always looking for what could go potentially wrong, and there is still cause for concern. It looks like we could be at the beginning of a fourth wave in the US as the more contagious new variants spread. And around the world, especially in India and South America, the pandemic is not in control, and vaccinations are proceeding much more slowly, which could give rise to new variants. In the US, we are transitioning from vaccine scarcity to concerns about whether enough people are willing to get vaccinated to achieve herd immunity. And there is a lot that we still don't know. The duration of vaccine protection, the implications of long COVID, and whether or not the vaccines are safe for children. As we return to a more normal life, we also still don't know exactly what that will look like. As schools reopen, especially full-time in-person school, will women re-enter the workforce? Will we continue to work from home, or will we return to offices and commercial centers? Will occupations that were hit hard by the pandemic return to their pre-pandemic employment levels? Will vaccine passports be required for work, for school, for travel, or for other activities? The American Rescue Plan will spend almost $2 trillion to preserve and stimulate the economy. Will it be enough? Will it be too much? And will it trigger an inflation spiral? Will the American Jobs Plan or infrastructure bill pass? And if so, how would it transform the economy? Will economic growth be sustained in the future? Or will it just be a short spurt as we come out of the pandemic? There are many reasons for optimism, but there is a lot that is unknown. One of the most important issues facing public pension plans is the continued downward pressure on discount rates. If future investment earnings can't be counted on to carry the load they historically have, pension plans will need more contributions to meet their obligations. The downward pressure on discount rates has largely been driven by lower interest rates in the economy. In the chart, the gray bars show the yield on a 10-year treasury, which declined from 5.3% in 2001 to 2.2% in 2017, and even further to 0.7% as of June of 2020. As interest rates decline, expected future investment returns also decline. As a result, pension plans have had to either reduce their discount rate or take on more investment risk to achieve their expected returns. The chart shows that plans have done a little bit of both, as the median discount rate dropped from 8% down to 7.25%, and the expected risk premium, which is the difference between the expected return and the yield on a 10-year treasury, has grown from 2.7% in 2001 to 5.3% in 2017 and 6.5% as of June of 2020. But the important question here is, what will be the level of interest rates in the future? The yield on the 10-year treasury has already increased since its extremely low levels in 2020. But the Fed is promising to keep interest rates low for the foreseeable future. If interest rates remain this low, there will be continued pressure to reduce discount rates. Most of the firms we work with set their capital market assumptions in December for the following year. And for 2021, those capital market assumptions are generally lower than they were for 2020. While each firm has a different methodology and sets different assumptions, both lower interest rates and higher market valuations seem to be driving much of the reduction in expectations. Depending on when your plan sets its expected return assumption, the outlook may change for a variety of reasons, but particularly depending on how the pandemic progresses, how the federal stimulus plays out, and if there is additional federal stimulus. One indicator to watch are inflation expectations. There's a debate among economists over the impact of the American Rescue Plan and other federal stimulus on the economy. All seem to agree that in the short term, inflation will increase, probably above the Fed's long-term target of 2%. The question is whether it will be a temporary spike and future expectations remain anchored around the Fed's long-term target, or if it causes future expectations to become unanchored and inflation to continue to rise. In that case, there's also the risk of the Fed overreacting or reacting in a manner that could trigger a recession. One metric economists are watching to get an indication of which path we may be on is break-even inflation. Break-even inflation is the difference between the yield on nominal Treasury security and an inflation-protected Treasury security. It represents a consensus expectation among investors of future inflation. During the pandemic, break-even inflation reached very low levels, with expectations at about 1.25% for the 20-year inflation in March of 2020. Since then, those expectations have shot up to 2.4% over 20 years and 2.5% over 5 years. So far, it's impossible to tell which economists are right. Will these expectations continue to increase, or will they return to a level amount near 2%. Right now, the lower 20-year figure provides a little support for the expectation of lower inflation after a temporary spike, but we will have to wait and see.
Inflation impacts both assumptions and experience of a pension plan. Remember, inflation is a foundational building block for the economic assumptions. As you can see in this graphic to the left, for the economic assumptions, expected return, salary increases, and cost of living adjustments, inflation is the basis of all of those assumptions, with expected return having inflation plus the real return on assets. For salary increases, you have inflation plus the productivity, longevity, and merit increases. And for cost of living adjustments, often inflation is used to determine those adjustments, or there could be some sort of other metric that's used for cost of living adjustments, such as return on plan assets compared to expectations or funding ratios. But if in fact inflation does start to get higher, the first impact you'll see on the pension plan, the immediate impact, will be for most COLAs. It really depends upon the plan design. Are there caps in place? But that's where we'll see the experience first on pension plans. For inflation, there'll be a delayed impact on salary increases. It really depends upon the bargaining cycle and the future expectations of inflation, and really if there needs to be some sort of wage inflation just to entice workers to work for you. And of course, inflation has an impact on the investment returns, and this varies by asset class. So COVID's long-term impact is still unknown, of course. Will COVID-19's impact on mortality tables be a one-time event, a blip, so to speak, or will there be long-term changes in mortality rates and experience? How about long-term changes in disability rates? And will those who retired or were terminated during the pandemic, will they return to the workforce, especially women who seem to have exited the workforce at greater numbers to deal with childcare? Well, in the end, the big question is, does 2020 experience represent the future? And the best way to answer this question is with an experience study. Actuaries will likely complete experience studies to see what's going to happen based upon past experience in the future. But the demographic experience studies covering this period will probably be very difficult to interpret. We'll probably have to apply significant professional judgment and look at experience study results first with the pandemic impact and then stripping out the pandemic impact. And then there need to be considerations on whether recent experience is likely to really represent the future. There could be a whole range of opinions that may be valid, and boards of trustees of pension plans should consider what they think for their specific state, municipality, city, and the impact could be as well. How will pandemic experience affect mortality improvement rates? Remember, actuaries have these mortality tables, and we have base rate mortality tables, but we also use mortality improvement tables. These mortality improvement tables are published annually. You can see in the graph to the left that the mortality improvement table, MP 2014, is the blue line. This was published in 2014. This was based on Social Security data through 2009. These mortality improvement tables have two components to it. One is the short-term experience that the table has, in this case, data through 2009, and then the long-term expectations of mortality experience, which is based on expert opinion. And then these two short-term and long-term rates are blended together to have a smooth mortality improvement rate. You can see here for the MP 2014 table how it declines once we get past the experience period up to 2009, down to about 1% for the future expectations of mortality improvement. Now let's fast forward to the MP 2020 mortality improvement table, which were published in October 2020. This was not based upon 2020 experience. This was based upon historical data through 2018. And you can see here with the green line how mortality improvement rates through 2018 were actually less than expected. So what does this mean for the 2020 data once that's applied to generate the mortality improvement scales in 2022? Could there be negative mortality improvement? Some speculate maybe this data will be ignored completely, or maybe again, some sort of expert opinion will be needed to modify the data. As we understand better the impact of the pandemic, these answers will probably be addressed. These questions will probably be answered. So going forward, how can public pension plans best position themselves, both during the pandemic and once the economy recovers? This is really a balancing act, and it's hard to balance when there are so many unknowns. There's the unknown of the actual plan experience during the pandemic, the asset returns, were the contributions made, and what's the future assumptions and expectations? So when there's so many unknowns, of course, the first thing to do is to get one of those unknowns crossed off the list. And that would be to complete the initial post-2020 actuarial valuation. This initial actuarial valuation would be reflecting the full 2020 experience with the increased in mortality rates, retirements and terminations, and of course we'll have the asset values as well. Actuaries will complete these evaluations, and then the question will be for plans to best position themselves for the future, what contributions will be paid? If contributions are currently less than the normal cost plus interest on the unfunded actuarial liability, then consider increasing the contributions. This is important to avoid increasing an expected increase in your unfunded actuarial liability. It would be like if you don't pay this, you're going to be increasing your mortgage. And of course, pay that UAL off over a reasonable period of time. Also, a thought is maybe using the investment gains to offset the cost of accelerating contributions or possibly reduce the risk exposure to the plan, which would thereby decrease the discount rate and increase the liabilities. But in the end, it comes down to what can you afford? And again, to best position yourself for the future, look at the assumptions and be cautious about making significant assumption changes just based upon the experience during the pandemic. Of course, assumption setting needs to follow the actuarial standards of practice, and putting too much weight or emphasis on the past year would be incorrect. Consider risks of different scenarios and take action to minimize the risk. In particular, consider reducing the discount rate to reflect those lower future expected returns.
In this low interest rate environment, we are seeing more discussion and action to either add leverage to the investment portfolio or for the sponsor to issue a pension obligation bond. In fact, yesterday I learned that 2020 was a record year for the issuance of pension obligation bonds. The argument for adding leverage to the portfolio is often that it is the most efficient way to increase the expected return to the level of the discount rate. The analysis considers the investment risks, and the board makes a decision much like they make any other investment decision. The argument for a pension obligation bond, however, is often different. Even when the risks are discussed, The rationale is often expressed in terms of refinancing debt, reducing the interest rate charged on that debt from the expected return of the portfolio to the borrowing rate for the bond. This isn't really the dynamic that takes place. It's different from refinancing a debt. From an economic standpoint, borrowing money with a pension obligation bond to invest it in the pension portfolio is just a different form of adding leverage to the portfolio. The pension plan's normal amortization policy fuels the refinancing argument and provides an incentive for pension obligation bonds by reducing contributions in the short term for the expected gain on the additional assets. And then over time, those contributions are readjusted for the actual investment performance. There are other amortization methods available for pension obligation bonds, and I'd encourage you to talk to your actuary about adopting a method that doesn't provide an immediate reduction in contributions for the sponsor after taking into account their payments on the bond, so that the contribution dynamics are similar to what they would be if instead the board had added leverage to the investment portfolio. Regardless of your plan's current situation, it's helpful to identify the potential risks to the plan and run some stress tests to get a sense of how large those risks are, how likely they are, and what the plan can do now to mitigate those risks. Investment returns and discount rate reductions are almost always the largest risks, but other risks such as inflation, payroll, and member growth rates can also be critical. Stress testing is an exercise to try to find out what could potentially go wrong and what, if anything, the plan can or should do about it. A typical stress test starts with a baseline projection, assuming all assumptions are met, and looks at some critical metrics of the plan. If the employers contribute an actuarially determined contribution, that will be one of the critical metrics. If contributions are fixed, you will need different metrics, such as the implied funding period or the amount of the unfunded liability. Stress tests project these metrics under scenarios that deviate from the baseline projection in order to test how sensitive plan metrics are to the scenario and whether the scenario is manageable. To keep a balanced view, we usually project both positive and negative scenarios, often starting with a relatively moderate or likely scenario and progressing to more extreme or less likely scenarios. To get a more complete picture and assess the likelihood of certain outcomes, we also perform stochastic projections showing thousands of scenarios. While both positive and negative scenarios are interesting and informative, our primary concern is making sure the plan can manage the negative scenarios. If a negative scenario with a reasonable likelihood is concerning, steps can be explored to attempt to mitigate that risk. So we want to wrap up and allow a little time for some questions. We as actuaries have become accustomed to delivering some pretty gloomy forecasts over the last decade. But today we believe there are many reasons for optimism. People are getting vaccinated. Fiscal year ending June 30th are shaping up to have very good investment returns, and the economy appears ready to rebound. However, there's significant uncertainty remaining in terms of the pandemic, economic growth, and in terms of investment returns. Plans should examine their sensitivity to these risks and consider using some of the benefits of any good investment experience for the current year, to improve contribution levels if that's what's needed, or to take other actions to mitigate the future risks. So with that, I'll turn it back to Hank to run us through any audience questions.
Great. Thank you, Bill. Thank you, Karen. That was a very informative presentation. Let me ask, given, sort of the surprising, I guess, the mortality rates relative to COVID and COVID related, right? The gray bars that you showed. To what degree do you think that certain employment classifications, so for instance, in the public sector, we have public safety and educators who have basically been back on the job through the pandemic. Have you noticed any fluctuations, or what has their experience been relative to the general population?
I'll start and then Karen can add on. I think we're still getting data. Most of my plans, the last data we've actually looked at was as of June 30th, 2020. And so we just had the impacts of the first part of the pandemic. And overall, mostly we were not seeing significant impacts. But we do expect that there will be differences based on the number of frontline workers in a plan. So as you mentioned, educators, in some cases where they were back in schools, we might see something different than where they were teaching from home, online teaching. And in the safety area, employees, they were obviously out and exposed. There are also general members who may have been exposed. We have noticed that there's, in the 2020 data, there are some significant differences by geography, which really reflects how severe the pandemic was in certain areas. Karen, do you have anything to add?
No, that's similar to my experience as well. We have June 30 plans. We weren't seeing high increases in mortality rates. We're in the process of reviewing data for 12/31 pension plans, but we're still looking it over, and we don't have a clear picture yet in terms of the impact from the pandemic. So, as we get the data and review this, then I think we'll have a clearer picture. But I echo your point, Bill, that probably there will be differences that we'll be seeing based upon the different types of pension plans, whether they're safety or general or teachers, most likely.
Yeah. And Bill, I think your point about regional or geographic variations, I think that's a great point as well. Particularly as, states, there have been some states that have effectively reopened, early part of last year. And it'd be interesting to see what the trend lines in some of these states that have opened, I guess I would argue prematurely, how they would impact the public plans in those states.
Yeah, I think that's right. And the other piece is how many of the public plan members were able to work from home versus, having to be in an office or on the front lines. I do think as we've come to understand that outdoors is much safer than indoors, there's also some discrepancies there. So some of the workers who continue to work but were working outdoors, we may not see much difference there.
Yeah. And then can you both sort of expand on your point about the risk of inflation and what sort of pressure it might place on setting the discount rate going forward?
Yeah, so that's a complicated one because we kind of pointed to two different risks that go in opposite directions and don't really happen at the same time. So if inflation increases and stabilizes at a higher level, and by higher, I don't mean like 10%. I'm not expecting something like that. But we've been at such extraordinary low levels of 1 to 1.5%, which if that stabilizes at a higher rate, we may also see interest rates adjust. And then the expected returns going forward from that point may actually be higher. And so inflation will have an impact on your COLAs, as Karen was explaining, as well as your salary increases. And a rise in interest rates may cause investments to go down initially. But once you've absorbed that going forward, that may allow a higher expected return, which would allow either reducing the risk in your portfolio or potentially even raising the discount rate, or at a minimum, reducing the pressure to reduce the discount rate. If, on the other hand, we continue with the low interest rates we have now, that's going to continue to apply pressure to reduce the discount rates. To the extent your COLAs are variable with and can reflect that actual much lower inflation, there would be some offsetting gains in your liabilities from there. But most of the plans we're seeing, there's not as much room for movement in the COLA as there is in the discount rate. So it is an issue to keep an eye on.
And it's an unknown. It's an unknown right now that everyone's watching very carefully. Everyone seems to have a different opinion about this. So as always, it's never boring. Something yet to watch and be aware of.
Okay, great. Well, and then finally, obviously, Cheiron and your firm is well known for your stress testing models and your advocacy of stress testing plans. Can you talk a little bit more about that and why you think having multiple stress test scenario is appropriate rather than being overly complex?
Do you want me to take that one, Bill?
Yeah, go.
Sure. So really, stress testing lets the boards consider multiple scenarios to see what they can and cannot live with. Really, and in doing this for a long time, we've learned nobody likes surprises. And so stress testing helps boards understand what's coming around the corner. And by having these quantitative stress testing scenarios, the board can really make plans for the future. You can see what's coming, then before it hits, then you can make the decisions to remedy a situation that's just unaffordable. We've worked with many pension plans where the stress testing scenarios have to be completely blunt, they're not what the boards want to see, and they're upset by it. But again, once you see this and then try to figure out a solution, either with creative ideas or thinking of other out-of-the-box scenarios, then sorry, I'm getting a message here. Then you can move forward. It can be confusing, but we would strongly recommend that all pension plans do stress test scenarios. Bill, did you want to add to that?
Yeah, I think there's some concern out there that the stress tests are being promoted to make pension plans look bad. And sometimes they do look very stressed when you do stress testing. But that's not really the intent. The intent is to figure out what does create problems for the plan so that you can try and figure out what you can do about it now. And make sure people are aware of what could be coming down the road for the pension plan. So there are plans that are in difficult scenarios and don't need to be looking at extreme stress tests because the current projections are difficult and focuses on managing a reasonable path forward. But there are other plans, especially now with the investment returns we've had this year. I have one large plan that's projected to be over 100% funded next year. And those plans really should take the opportunity to check what could go wrong in the future and try and take steps to maintain their position.
Yeah. And if I could take a moment to editorialize a little bit, Bill, on your last comment. Yeah, I think unfortunately in the public plan space, there has been this somewhat of a well-known organization out there effectively peddling their, and I'll use air quotes, their stress testing model to state legislatures and plan sponsors, which have really colored the whole notion of whether stress testing is objective and the purpose of stress testing. And I think for reputable organizations like Cheiron and other actuarial firms who provide these services to plans and to the plan policymaking body like the board and the senior leadership, I think it makes eminent sense. But again, for some other organizations that are effectively just peddling stress testing to legislatures and essentially trying to embarrass public plans, unfortunately, they've colored the notion of stress testing. But
yes, and that is an issue. And I think the way to really think about this is the stress test should be designed by the board for the purposes of the board that has fiduciary responsibility for the pension plans. And it's intended to help them make the decisions they need to make. And so the stress test should be designed accordingly.
Couldn't have said it better. Karen, Bill, thank you so much for your time and this wonderful presentation. And to our audience, thank you so much for joining us today. And we look forward to hosting our next webinar in June. Thank you.
Thank you.